Hey, this is Jim, and this is level 3 of the CFA program, the topic on ethical and professional standards, and the reading on an overview of the global investment performance standards. This is part 1 of 2 parts. Remember all the way back in the beginning of level 1 where we had a conversation on the code and the professional standards. And we used words like integrity and loyalty and objectivity and transparency. We had conversations on misconduct and misrepresentation. Well, this reading is essentially a summation and an application of all of those standards to the manner in which we present our performance to the investing public. I'm going to give you a quick analogy here. It's one of my good analogies. It's not a perfect one. But I want you to think about this overview as an application of some of the models that we've talked about in levels 1, 2, and 3. Just a quick one. Let's go back to that Myron-Gordon growth model. Recall that we estimated the intrinsic value of a share of stock based on the present value of the dividends, and then we probably compared that to the market value to find if the stock was over or undervalued. Well, here in these performance standards, what the Institute wants us to do is to come up with a performance presentation in which the intrinsic value and the market value of our performance are the same number. Right? We want to tell the investing public exactly who we are. We don't want to misrepresent. We don't want to engage in any misconduct. We want to have transparency. We want to have all of those good things. Here's my Jim's 13-year-old analogy here. We don't want to fake anybody out. That's exactly what the Institute is trying to prevent. Now, one of the cool things about this reading, and I always encourage candidates to go and look at the readings. There are 20 some really awesome questions at the end of this reading, and we'll talk about that, especially after we do part 2. But in the very beginning, the Institute says something like, and I'm kind of paraphrasing here, candidates are responsible for all the stuff in this reading, but they're also responsible for this extra reading. And I put the link there so that you can go to that extra reading. I mean, it's a bunch of pages. And you'll probably think, oh my gosh, do I need to know all this? Because it's essentially just a page after page of bullet points. But what I think is super important is at the very end, there are some really cool examples of actual performance presentations. And so I'm guessing the Institute is probably going to use those models at the end of that extra reading as example and exam questions for you guys. So we'll just do 3 LOSs here today. Objectives and scope, that'll be pretty easy. Fundamentals of compliance, that's probably the bulk of it. And then we'll do a little bit of math to finish up part 1. So let's go ahead and start with pretty much an introduction here. So what are we doing here? Rationale, an application of the 2020 edition of those GIPS. Effective date, January 1st, 2020. Not quite sure if that's a date you should remember, but I'm guessing it's one of those things that you should put way, way in the back of your brain that you can pull out if you need it. We'll go ahead and focus on these 3 issues or 3 chapters, the Institute calls them. Standards for the firm, asset owners, and then verification. We'll do a bunch of that in part 2. All right, so what are we doing here? Essentially, we need to establish, and the Institute has established kind of like minimum acceptable presentation report standards. In other words, for prospective clients and prospective investors, we need to go ahead and say something like, all right, this is the standard. And we can put it in almost any form that we want. Not almost, but we can present it however we feel like it. But it has to meet these minimum acceptable standards so that it is a fair representation, completely full disclosure, which allows investors and clients to say something like, okay, here's this one manager and here's another manager, and we have their reports, and we can make a direct and a fair comparison to evaluate their performance. Now, remember I used the term just a few minutes ago. Back when I was 13, we used to try to fake everybody out, especially on the football field or the basketball court. But this is what the Institute calls, notice what we have in that first highlighted diamond point, deceitful practices. So you can't cherry pick. You can't have creative estimates. Now, with creative estimates, clearly you're not going to be creative when you're trying to value a company like Johnson & Johnson at the end of the year. I mean, whatever the New York Stock Exchange tells you what it is, well, that's pretty much what it is. But creative estimates, oh boy, these are super important for that entire alternative investment universe, and probably even for some fixed income securities. You can't annualize partial period results. I mean, every money manager in the history of the world, dating all the way back to the time of the Phoenicians, had some time period, maybe it was just a week or maybe it was a month, where their performance was awesome. And so you could just compound that out for a year and say, oh my gosh, here it is. Well, that's a creative estimate. And it's partial period and it's cherry picking measurement periods. Of course, we can't present simulated returns as actual returns. And the reading here is very clear in its emphasis on the selection not only of an appropriate benchmark, which we've talked about in many, many other recordings, but reporting that benchmark right alongside. I've told you guys this before. When I teach in my finance trading lab, we have Morningstar and we have the Bloomberg terminals. And so in the Morningstar, you always have this particular fund, and then you have a couple of other funds that are, pretty much like them, but I guess it's their benchmark. You can't mask any difference between, returns and client contributions or disbursements. We'll talk about that at length. Look at that last one here, graphic design trickery. I have no idea what that means, being a non-artist myself, but I can imagine graphic design trickery means that what you're doing is you're faking somebody out by using some type of a pie chart or some other kind of design to make it look like our performance is better than what it is. All right, sound investment decisions in selecting investment managers. This goes back to one of those words that I mentioned earlier. What did I say? Transparency. But another thing that this does is it boosts confidence so that we can compare this person and this person and that person, all these different fund managers out there, so that not only does the investing public then have confidence in these GIPS presentations, but then it seeps out into all other parts of society. There's a bullet point on alongside an appropriate benchmark. Benefits here, I've been talking about this. Credit to both professionals and organizations, right? May reassure investors. Benefits to individual firms. Wow, look, if we're outperforming, then of course we want to tell everybody that we're outperforming. And of course, if we're outperforming based on some acceptable standard of presentation, well, then everybody will know that we're outperforming. What it does is it allows us to compete not only domestically, but internationally. And then the other side of this is if we are presenting this as our core intrinsic value, then what it's going to do is promote a culture of transparency and integrity, which means that we're probably going to be able to look at some type of an internal control or infrastructure and improve upon it. All right, here's a big potential exam question. Who can claim compliance? In fact, a couple of the first questions at the end of this reading address this exact issue. Investment firms, asset owners who manage these portfolios on a discretionary basis. And the reading goes to great lengths. And that extra reading that I referred you on that first slide goes to great lengths to tell us about what is discretionary and what is not discretionary. And so remember that if the investment manager has any type of decision-making ability, then that's probably a discretionary portfolio. Let me give you just a quick example, and I'm going to go ahead and start with one that was taken right out of that extra reading. Suppose that you manage 50 different clients, and 40 of them you have full discretion on their portfolio. In other words, they say something like, here's our money, and do whatever you want with it, right? So you have full discretion. But then the other portfolios that you manage, you have clients who say something like, well, I'm going to put a restriction here and a restriction there and a restriction there. Well, then it's up to you to decide whether it's discretionary. But the Institute is very clear that if you have, kind of like a majority discretionary basis for investing, then it needs to be included in this entire concept of claiming compliance. Let me give you just another quick example here. Suppose that I send you all my money. You guys are my investment manager, and let's suppose it's $100,000, and I inherited $5,000 or $7,000 or $10,000 worth of stock from the company that my mother worked for. And when she was dying, she said, "Oh, Jimmy, I don't want you to sell these stocks. It was a great benefit for all of our family, et cetera, et cetera." So I had some kind of an emotional attachment. And so in that $100,000, you have $5,000 or $6,000 or $7,000 worth of this company stock, but you have discretion in the rest of that portfolio. So of course that would be included. All right, so here's a great exam question. Investment firms and anybody who manages assets, they can claim compliance. Of course, they have to adhere to all the rules and the regulations. Consultants, software providers, third-party performance, these people and these organizations are not able to claim compliance. But here's the important thing. This is on a firm-wide basis. You can't just say something like, oh, we're compliant over here, but we're not compliant over here. You can't be compliant with composites and not compliant with pooled funds. This is on a firm-wide basis. So make sure that you pay attention to the question STEM, and I'm pretty sure that the Institute will probably use that term or a similar one, firm-wide basis, or they might make it sound really, really good by saying, hey, we comply here, but over here, this is not too terribly important and we don't comply. So that's a violation. Yeah, so what this means, the implications are that we have measurement data inputs, we have a process, we have a return calculation methodology, and all of the fee-paying discretionary segregated accounts have been included in at least one composite. Now, what the reading does is it gives us some good definitions. So here's a composite, one or more portfolios managed to a similar investment mandate. So let's go back to my examples. What was that? I had 50 clients and 30 of them, let's suppose those 30 were managed according to a large cap growth objective. Well, then those 30 would be thrown into one composite. The other 20, maybe they're small cap and their value. Well, then those 20, they would be thrown into another composite. So one or more portfolios. Segregated accounts, then, these are just separately managed accounts for one client. Typically, these are, higher, I don't want to say ultra high net worth, but higher net worth clients. And then the Institute has included a third category, a pooled fund, and these can be further divided into either limited distribution or broad distribution pooled funds. And that's probably the difference between the third category and the first and second category. So look at the broad distribution pooled fund. Think of these as just regular old mutual funds. The limited distribution is anything that's not a broad distribution pooled fund. And so think about these are hedge funds or private equity. So remember that terminology, but you guys probably know that without me emphasizing. Here's a good slide of a summary of what I've been saying here. Ethics and integrity, trust, right? Universal demand for compliance by asset owners, right? This makes perfect sense. What are the objectives? Investor interest. Here's one that we haven't talked about, right? Ensure accurate and consistent data. Consistent meaning that we do the same thing over time and that it is accurate to reflect that intrinsic value, so to speak, of our portfolio and our management skills. Worldwide acceptance, fair, global competition. There we go. Self-regulation. This is taken right out of the reading. Key concepts, fair representation and full disclosure. There we go. Minimum requirements. This is what I was saying earlier. Firms must comply with all applicable requirements of the GIPS standards, and this includes all that stuff. All strategies managed on behalf of or marketed to segregated account clients, right, to prevent firms from, there's that word I used earlier, cherry picking. Yeah, some extra things here about the integrity of the input data, right? No exceptions. You can't have one thing in one year and then a different thing in another year, right? We need to do this. That's the word consistent that I talked about just a minute ago. Of course, we need periodic internal compliance checks. We've talked about this all the way back in level 1. What does the Institute like us to do? They like us to review and they like us to monitor. So, of course, they're going to ask us to do this when measuring and reporting performance. Of course, we have to be compliant with all the laws and regulations. Now, we'll go ahead and discuss the sections of the GIPS standards over the next bunch of slides. So here we go. Fundamentals of compliance. This is the definition of the firm. Input data. This means consistency of the input data. Composite and pooled fund maintenance. And then how do we calculate returns? And then how can we advertise? So let's go ahead and start with those fundamentals of compliance. In this reading, there is a definition of the firm, which is the focus and the emphasis. In fact, the very first question at the end of this reading is one on the definition of the firm. Distinct business entity, a unit, a division, a department, or an office, right? That is functionally segregated from others in there. So that's the firm, right? Distinct market or client type, separate and distinct investment processes. Notice that first arrow point, it requires judgment. I'm going to go back to that first question at the end of this reading. There's a firm that has two distinct mandates for its client relationship. And so it has one, and I forget the name of it, and there's another, and I forget the name of it. And the question is, and it's an open-ended question, essay question that says, all right, what should the firm do? And the answer is, well, it needs to define what it wants to do. It can either have this one separate and this one separate, or it can combine it as long as everybody knows the combination or the separation. What this judgment then does is it gives the potential investors and clients an idea of total firm assets. And this seems to be a big deal. Whenever you read the Wall Street Journal or any other kinds of publications, you read, okay, here's an asset manager. And it always says, oh, there's $80 billion of assets under management. So this is a super important part of the professional industry. And so the Institute kind of piggybacks on that. This is what I was saying just a little bit ago about this definition of discretion. What does discretion mean? Of course, it means that we have the ability to make these decisions. So what does this mean? All discretionary fee-paying segregated accounts must be included in at least one composite. Of course, some accounts can be included in more than one composite. What this does, the great exam question is going from kind of the general to the more specific. Suppose that we're managing a large cap fund. And so we have 100 different accounts in that large cap fund. That's one composite. And then somewhere in there, we have large cap growth. Well, so large cap growth could be included or could be excluded. And so you can throw those into multiple composites. Yeah, here's a good definition down there. So manager can deliberately implement an investment strategy. If a client impedes the management's freedom to make investment decisions, the manager must determine whether the portfolio is discretionary. This is what I was talking about just a little bit ago about my mother saying we got that $5,000. So is $5,000 out of the $100,000, is that sufficient enough? I think the Institute uses the word substantial several times in there, which allows, what does that say there? The manager must determine whether the portfolio is discretionary. So there's really no idea of a sense of what substantial means, but it's kind of like those comments when you look at a piece of art and you say, well, I don't know anything about art, but I know if I like it or I don't like it. And so the Institute is not going to say, look, substantial means mathematically this or this. How about some other fundamentals of compliance? Minimum number of years. The Institute wants us to report a minimum of 5 years, or since inception. They want to do this all the way up to 10 years. They want us to document. They want us to comply. There we go. Avoid false or misleading, right? Concerning the distribution, right? Use of total return benchmarks. This makes perfect sense based on what we've talked about through levels 1, 2, and 3. We want to maintain the data. We want to store it. We don't want to violate anybody's privacy. We want to keep it private and contained and confidential. This last bullet point, I think, is a great exam question here. Which performance may be used or linked to that of another firm? This almost always, it doesn't have to, but almost always relates to when investment firms merge. Let's suppose that I'm Jim and I have my own investment firm, and you guys have a big investment firm out there. And I've been in existence for, and let me just pick a number of years. I've been in existence for 10 years, and you guys have been in existence for just 3 years. So you take over my company, and you use my year 4 and 5 to get up to that 5 year, right? At least 5 years. Does this comply with the GIPS standards? Well, the answer is that it depends. Let's suppose that it's just me, Jim's investment firm, and when you take over my firm, I decide to retire. You pay me, $50 million for my firm, so I go live on the beach or at the lake house somewhere. Well, if I'm not working for you, then you cannot use my years 4 and 5 as part of your historical performance. But if I come on board, well, then you probably can. I think this is another area where the Institute uses the word substantial in its readings. Instead of it just being me, let's suppose it's all my family members and cousins and uncles and best friends, and there are 15 of us in this firm. Well, if 15 of us come along and we now work for you, then clearly that's substantial. If 8 do, is that substantial? I don't know. You guys have to figure that out. I can't imagine the Institute would give you 8 out of 15 or 11 out of 15 or 2 out of 15. But probably the key word in there is the substantial number of Jim's employees are going to work for the acquiring firm. Therefore, yes, we can use those. So used or linked to that of another firm. Just think about that in terms of being acquired. All right, here's the section of the LOS where we're going to have a conversation that we did all the way back. Isn't that the very first reading in level 1 these days, where we try to figure out how to compute return? Do we want to use an average return? Do we want to use a geometric return? Do we want to use some other kind of return? Well, what the Institute has fallen on, and this, of course, is accurate and appropriate and reasonable, is that we're going to use an internal rate of return. Back in the old days, they called it a geometric return. And so both time-weighted and money-weighted, these are internal rates of return. But the Institute uses the word geometric. And what the important part here, and I'm hoping that I'm just reminding you guys of this, when you use a geometric return, what you're doing is you're specifically and explicitly measuring the change in wealth of the portfolio from one period to the next. So we're going to focus on time-weighted returns, which essentially removes all of the contributions and the disbursements of the particular fund. Now, there are times when we can use money-weighted returns, and I'll talk about that in here just a second. Look at that first diamond point, this is what I was just saying, negates the effects of external cash flows. What the Institute wants us to do is they want to value our portfolios monthly. And there are some exceptions, of course, private market investment portfolios in which there's probably not monthly data. But of course, we want to do the private market investment portfolio performance. We want to measure that at least on an annual basis, but we're not required to do it monthly. We're going to do it at the calendar month end or the last business day. And this is where it gets a little bit interesting. Go back up to the top. This time-weighted return negates the effects of external cash flows. But what happens if we have a large cash flow? So to illustrate that, let me give you just a quick example. So let's suppose I'm your money manager and you send me $100. And I go ahead and invest it according to some mandate. Maybe it's large cap, maybe it's small cap, whatever it is. And over the next 6 months, the portfolio value fluctuates. And at the end of 6 months, it's valued at 105. So clearly that's a 6-month 5% return, assuming that I didn't make any disbursements to you, you didn't send me any other cash flows. But at the end of 6 months, you have an uncle who has died and has left you with another $100. So you send me that $100. Well, if I just add that to the portfolio, at the beginning of the year we had 100, and after 6 months we had 105. Now we have another 100. That's 205. Boy, that sounds like I doubled your money, and clearly I have not. So what we need to do is what does that third diamond point say? Portfolio must be valued, and a sub-period return must be calculated at the time of the large cash flow. So what happens at the end of 6 months? We start with 205, and then I invest that extra 100 in similar things that I invested the first 100, and during the course of the year it goes up to 210 and down and whatever it was. So at the end of that period it has gone up by let's say 4%. So what kind of a time-weighted return? Well, we would do 1.05 times 1.04, and then we would get that, well, what does that turn out to be? 9.3% or something like that. That would be our time-weighted return because they were actual returns for the first 6 months with a $100 portfolio and actual returns for the second 6 months with a $200 portfolio. Now, getting back to that definition of discretion that we just discussed a few moments ago, we need to decide what is the definition of a large cash flow. Large enough to affect the return if the portfolio is not valued and a sub-period return is not determined. So clearly in my example, the $100 inheritance, well, that's a large enough to affect the return. $1? I don't know. 1%? Maybe. So we need to link back to that word substantial that the Institute likes to use. But I'm guessing in the question stem that the Institute would give you a sentence that says something like, this is a cash flow large enough to affect the return. There we go. Private market investments must be valued quarterly. We said that just a moment ago, at least annual for pooled funds. Any subscription or redemptions, we must be valued at that time. Now, I'm guessing that you recall the simple calculations from level 1. So there's just the way I teach my students, just an F over P minus 1, future divided by present minus 1. Well, there's the standard formula there. Ending value minus beginning value divided by beginning value. What are we going to do if we include these external cash flows? Remember that the time-weighted return removes all of these, but what we're going to do is we're going to have a discretion if we receive this cash flow. But look at that green diamond point. The standards for firms do not require that the portfolio be valued as of the cash flow date. I mean, think about it. As a money manager, you could have cash flows coming in every day, cash flows going out every day. But what we can do is we can adjust for daily weighted cash flows, and we'll do that here in just a second. But first of all, look at the bottom, what is that, a green box? For the time-weighted return, this is exactly what I just did a moment ago. 1.04 times the 1.05, and then you go ahead and subtract the 1. Notice what we have bolded there. Geometrically linked sub-period returns. This is exactly what I just did. Now, getting back to this concept of what is the discretion. Now remember, the GIPS standards does not require us to go ahead and compute a time-weighted return, adjusting for all of those cash flows, because, we would be going and like pulling our hair out trying to figure out, all right, are we net inflow and net outflow today or tomorrow? Let's really focus on our returns. Well, one way to do this, and actually there are two ways that the Institute teaches in this reading, is the modified Dietz way, which I'll show you in a calculation here in just a second. And then the modified internal rate of return method, which I will not show you here, and I'll explain that here in just a minute. But go ahead and look at that last purple diamond point. They both weigh each cash flow using the proportion of the measurement period held in the portfolio. Now, rather than just go ahead and work through some definitions and some explanations and theory, let's just work through a quick example of time-weighted return, and then we'll go ahead and do the Dietz return. All right, so here we go. We've got $1 million as of January 1st. By February 10th, we've increased that by 10%. But that includes an additional contribution of $50,000. All right, so that 10% is not really 10%, right? The ending value at the beginning of April was 1.35 million. So what do we do as this time-weighted return? All right, so let's start with that equation that we have right there. So we start with the 1.1 million. We're going to go ahead and subtract out the initial 1 million and divide by the initial 1 million. But we also need to subtract out that additional contribution of the $50,000. So that gets us to the 5%. This is exactly what I was telling you in that simple example earlier. Then the second period return, we got the 1.35 million, and then we subtract out not the 1 million, but the 1.1 million, because that's the second starting amount, right? Divide by the 1.1 million, there's 22.73, and then you just do the math quickly like we did before, and there's the illustration, there's the calculation. You can go ahead and confirm that with your calculator early. Now, what the modified Dietz approach does is it is a time-weighted rate of return. So we're going to do the exact same things. Notice in that Dietz formula, we have V1 minus V0 divided by V0. But what we're going to do is we're going to go ahead and make some simple adjustments to the numerator and some simple adjustments to the denominator. So all we're going to do is, excuse me, in the numerator, we're going to take out the cash flows, and then in the denominator, we're going to add a weighted cash flow depending on the number of days that cash flow occurred. So let's do a simple continuing example. Let me just go back here. Here we go, January 1st. February 10th, and then April 1st. So let's go back here and notice that 2020 is a leap year. We put that in blue up there. If the Institute requires you to know which years are leap years and which years are not, there's probably a really simple example to figure that out. But really, if you don't pass level 3 because you forgot 2020 is a leap year, well, I can't imagine that would be the case. All right, so let's look at that simple calculation for the weights. And this is just like we've calculated weights throughout the CFA program. So we'll do 29 minus 28 and then divide by 29. So there's the weight. What is that? 65.52%. And by the way, I went and calculated this assuming that we didn't remember that February of 2020 was a leap year. And it's just a minor difference in that. So there's our modified Dietz return down at the bottom. Multiplied by that 50,000 times the 6552, you get 29.05%. If you put 28 days in there, I think you get 29.07%. And remember, the institute is they're very big on asking the question. The correct answer is closest to. So I can't imagine they would say closest to 29.05% or 29.07%. Either way, you get 29% for this. Now, the reading is fascinating because I loved the modified internal rate of return calculation that we did back in our capital budgeting conversations at level 1. Remember, the Institute wanted us to compute net present value. It wanted us to compute internal rate of return, and it wanted us to compute the modified internal rate of return. And that modification back in the old capital budgeting days was just to assume that the cash flows are reinvested at the firm's weighted average cost of capital. Here, the modification is just a little bit different. What we're doing is we're modifying based on the number of days. So if you look at that equation there in purple, and you look at that equation there for Dietz, they are super, super similar. But here's where it gets fun, especially for you candidates who are looking for shortcuts. Notice in the green, it is solved iteratively. And according to the reading does not have an example, nor is there an example at the end of the reading that asks you to compute the modified internal rate of return. No, what it does is it says something like, here's Dietz, and here's the modified internal rate of return. And wouldn't you know that modified IRR and the Dietz number, they are really, really super close together. So computer programs can solve it efficiently. And in fact, the difference, you might have to go out to the third or fourth or even fifth significant digit to find a difference between these two. Now, there are some cases mathematically where there are going to be some difference, but I can't imagine that the Institute will go ahead and require you to know those differences. So here's my advice. My advice is work through this example. And by the way, there's a good example in the reading, so you can do that one, and then you can look at one at the end of the reading. So be able to calculate this, and then in the back of your mind, back here, right in front of where you have 2020 was a leap year, have that, okay, the modified internal rate of return is going to give me some number that is really, really close to that modified Dietz. All right, how about a summary of the standards on external cash flows? So what the Institute wants us to do is to formulate and document, of course, we say this all the time, composite specific and pooled fund specific policies for the treatment of external cash flows, right? Just consistently adhere to them. So if we do it this way, so let me go back to that word substantial. We decided based on our discretion and our substantiality, not sure if that's a word, whatever that is last year, well, then we need to do it this year, and we need to do it for each of our composites. So we need to describe our methodology and calculating those time-weighted returns, and then we need to document them and follow that policy. I mean, that makes perfect sense. Now, when are we allowed to use what we used to call in the old days a dollar-weighted return? Now somehow we reverted to the money-weighted return, and there's pretty much only one condition here. It's when the firm has control over those external cash flows, and so these are most likely closed-end funds, fixed life, or fixed commitment funds, or if there are illiquid investment that are a substantial part of the investment strategy. Those money-weighted returns must be computed annually. You cannot annualize returns. We said that earlier because, well, that's one way to fake someone out. You must include cash and cash equivalents in there. You must deduct transaction costs. One of the things that the Institute is probably going to ask on the exam is the form of, all right, here are our transaction costs. So we know these, here's the question stem. So we have these things here, and these are the actual transaction costs that were incurred. And then down here, we estimate that we incurred some of these things, but we're not quite sure when we did it. We don't know if it was this period or last period, but we're going to go and estimate them. All right, so look at that last block point. Transaction costs can be estimated for a specific portfolio only if actual transaction costs are unknown. So that's probably a really important question. And there's some checkpoint marks there that give you some examples. What if we bundle them? Then go ahead. There's some more check marks. You can include any combination of the following. Those all-in fee arrangements, those are pretty common. If you cannot identify them and segregate them from the bundle fees, then just throw them into the gross of fees and then reduce the portfolio performance by those gross of fees. Fair value methodology, of course, we know exactly what the price of Johnson & Johnson is on a certain date on the floor of the New York Stock Exchange, but we might have to use some other model out there, right? And so what this means is that, whatever model we use and whatever comparable transactions that we use, we need to just make sure that they, at least recently, were reasonable with this arm's length transaction. Objective, observable, unadjusted, right? Oh, look at the second checkpoint. This is important. Includes any accrued income. Now, this is another application of what the Institute asked us to do. I think this was back in level 2 where we had a fixed income security. We had to compute remember the dirty price and the clean price. We had to do all that kind of stuff. Now, I missed that bottom part there. So, if they're not available, those objective, observing, unadjusted, if you can't find those in the quoted market, well then in declining order of preference, quoted prices for similar investments in active markets, quoted prices for similar investments that are not active, then market-based inputs that are observable, and then subjective, unobservable inputs, which means that we really have no idea how much it's worth. That takes us through part 1. So we've completed those first 3 LOSs. We'll go ahead and do the rest of them in part 2. What I want you to do now is I want you to take, I'm going to say 20 minutes. I want you to go without any pen or paper. I want you to quickly read through those 23 or so questions at the end of this reading and just see if you can answer them based on what we've done. But then at the end of part 2, I'm going to ask you to take 50 minutes or so and answer those with your full effort. All right, so there we go. Hey, thanks for watching, and have a great day, and good luck studying.